So next topic of chapter 5 is the forward market. So let's look at from the forward quotation. So forward market is the market that is a foreign exchange market. They trade forward contract, which is the contract that promise to buy, sell the foreign currency in the future at a agreed price. Bank quotes for 1, 3, 6, 9, and 12-month maturity. So basically 1 month later, 3 months later, 6 months later, 9 months later, and 12 months later, and at a price rate and at a agreed price for the contract. Longer term, the swaps are available. So this is the example of the forward rate quotation. So consider the exchange rate shown to the right. So 1 month, 3 months, 6 months forward. And the first column is in US dollar per pounds. And the second column is pounds per US dollars. For British pound, the spot exchange rate is $1.4402 per pound, while the 180 forward rate is $1.4416 per pound. So this actually implies that the market participants expect that the pounds will be worth more in dollars in 6 months. That's why the forward rate is 14416. So how to get the dollar holding period returns? So when you calculate the returns, the numerator is the gain. So you buy spot and you sell forward, then you're gonna get $1,400. That's the holding period dollar returns, and divide by 1.4402 million. Then per dollar, you're gonna make about $0.001. So if you annualize it, then the return is I don't think this is negative, 0.0972%, because if you calculate this is 1 times 2, because this is 6 months rate, then it's going to be 0.1944%. That's the holding period return if you invest this forward contract. So the interest rate differentials implied by this forward is actually implied by the forward premium or discount. So for example, suppose the euro is appreciating from spot to forward 180 days. Then the 180-day forward premium is given by the premium equals to forward minus spot divided by spot. And this is annualize it. So 180 days basically 6 months. So even though we have 365, we usually just use the 360 as a numerator, so times 2. So the forward rate was 1.1389 minus 1.1321 divided by 1.1321 times 2. Then you have 1.2% premium. Now, if the interest rate depreciating, then you have discount. So that's forward premium for discount. So if you agreed to sell something, then you are in short position. If you agree to buy something, that you're in long position. So same as any stock futures, any futures actually. If you have agreed to sell FX, the foreign exchange forward, you are short position. To buy, you are long position. So that's the definition of long and short. So consider the payoff at maturity. So long position is 6 months for contract is 1.4416. So your payoff is basically keep increasing if you your pounds appreciate. So it's basically the long position to buy pounds, which means that if the pounds price keep increasing and if it is greater than this forward rate, then you better off. If it is below that, then you're worse off. So that's the speculative forward contract. You can also use this forward contract as hedging because you can actually just set up this rate as your future exchange rate, so you don't have to worry about, like, you can just plan that you have set this exchange rate and just use this foreign currency. So that's the hedging way, but you can also just speculate using these payoffs. Because of the government-initiated capital control, the currencies of some emerging market countries are freely traded. As you know, like we have many countries actually who manage these foreign currencies. Sometimes the emerging market countries, you cannot freely trade. For many of these currencies, trading in non-deliverable forward contract exists. So this non-deliverable forward contract settled in cash, usually just US dollars. So they use the value of these the currencies, but they do not deliver it because they cannot. They just trade based on the US dollars. So settlement is calculated by the difference between the forward contract and the spot price at the maturity date, and multiply the contract size and use the US dollar they trade, they pay off. Forward cross rate. The 3 months forward euro per cross rate here is basically you can use the same thing, same way. You use this 3 months forward and bid price times the per pound. So dollar times euro times pounds times dollars, and dollars cancels out, and you have pound per euro, right? So you pick this one, dollar per euro, and that one actually dollar per pounds. You can get the pounds per euro. Now, currency symbols. In addition to the familiar currency symbols that we saw, the pounds, yen, euro, dollars, there are 3 letters code usually for all currencies. There's long list. I just selected some of them. So CHF is Swiss franc, GBD is a British Britain pound, so British pound. ZAR is a South African rand. CAD is a Canadian dollar. JPY is a Japanese yen. So that's the example of them. Swaps. Swap is another way of the get a currencies without forward contract. It's like forward contract, but it's basically just they exchange it, usually sometimes longer term. So the swap is agreement to provide the counterparty with something they want to exchange for something that they want. So often recurring basis every 6 months or for 5 years. Swap transaction accounts for approximately 56% of interbank forward trade market, which means that swap is pretty large. Whereas our trade is about 11%. Okay, so we're gonna see this swap a little more detail in chapter 14. Now, you can actually so individual shares are denominated in the US dollars, which is called the exchange traded currency funds, and this fund is traded on the New York Stock Exchange. It's ETF funds. So consider an ETF where each share represents 100 euro. The price of one share at any point in time will reflect the spot dollar value of 100 euro plus accumulated interest minus expenses. You know, so it's basically the funds, the securities that you can trade in the New York Stock Exchange. Exchange traded currency funds. 6 additional currency trusts exist So along with the euro, Australian dollars, sterlings, Canadian dollar, peso, Mexican peso, Swedish krona, and Swiss franc. Now currency is now also recognized as distinct asset class. So this is currency is also asset. Currency ETFs facilitate investing in these currencies. So you can actually just bet on the currency changes, appreciate, depreciate, using the currency ETF without just a trading currency itself. So for example, if you think that the Canadian dollars will appreciate, then you can buy the funds, exchange trade currency funds on the Canadian dollars, not directly buying Canadian dollars. Okay, so that's the end of the chapter 5. Thank you, and see you in chapter 6.